My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends? I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. When good things happen to bad stocks, I get nervous. Lately, we've seen a lot of low-quality stocks rallying purely because too many hedge funds shorted them at the same time, and those shorts end up getting squeezed. Remember, just like they did in late January 2021? Although lately to a lesser extent, but it's been behind a lot of the action. Today, though, with the Dow slipping 58 points, S&P backsliding 0.42%, and the Nasdaq tumbling 1.19%, and it was worse most of the day, the short sellers, well, they actually won. And in this case, you know what? I think it's a good thing. There's a whole contingent out there that sees betting against the shorts as some sort of brilliant strategy. It's not the case. First of all, it's not even a strategy. I like to think of it as a high-risk tactic that can easily blow up in your face. So let me give you some examples from today's trading, starting with the incredibly volatile Bed Bath & Beyond. A few years ago, they brought in this terrific manager from Target, Mark Tritton, chief merchandising officer, to turn things around. Bed Bath got a total makeover with some exciting private label brands, too, but the customers didn't like it. And the same-store sales fell to an unfathomable minus 23, minus 27 when it came to the main store. So Triton got fired. The interim CEO, Sue Gove, has been dealt a weak hand. The stock recently fell to $4 and change in the days after Triton got axed, and the projections are horrendous. At the same time, Bed Bath's formerly beautiful balance sheet has gotten so ugly that its credit rating has been downgraded to near bankruptcy. Yet in less than 6 weeks' time, this moribund stock, flew from $4 to around $13, where it peaked yesterday. Why? Did something good happen? No! It's just that Bed Bath & Beyond has a small float and a ton of short sellers. The short interest made up 42% of the shares at one point. That's way too much, people. Whenever I had a short at my old hedge fund that got this crowded, as we call it, I would skedaddle. So Bed Bath rallied on a short squeeze, but nothing good at the company. Now, the stock finally broke down today, off 14%, because people like me were talking about how the company might take advantage of this momentary run-up to sell, let's say, 10 million shares to fix their balance sheet problems. Of course, if they start issuing new shares, that resolves the short squeeze and sends the stock lower. Isn't it an odd conundrum where a company that needs to raise money is basically on the side of the shorts, not the longs? In other words, if you're beating up the shorts, hoping they'll be forced to cover as the stock shoots higher, management might take advantage of your buying to do an equity offering that just crushes you. Hence the 14% decline of Bed Bath, which increasingly looks like a lot. I don't know, how about like the old J.C. Penney, when they switched strategies and alienated seemingly their entire client base? How about another example? Take a look at Upstart, the artificial intelligence-fueled lending platform. I believe this company initially I like the model because I thought they were just facilitating loans, not lending money themselves, not against their own capital. However, the whole financial technology cohort collapsed late last year, and this stock has been obliterated, dragged down by the fact that Upstart's actually on the hook for a lot more loans than we thought. Staggering. It's just staggering. According to the late July note from the analysts at Wedbush, they've got a 4.8% delinquency rate for a recent vintage of loans, which is distinctly suboptimal. And I've got to tell you, a lot of people felt I gave the company a hard time when they were on last time, but I did that to help save you money. In early July, Upstart guided numbers down huge. Last night, the company delivered the full report and guidance for the current quarter, and I gasped at how bad things are. Next thing you know, though, the stock's it opened up to almost 10%. Why? Short squeeze. 38% of the float is sold short. That's produced a tremendous rally over the last week. The longs ran the stock up this morning, hoping they could force the short sellers to capitulate. Nothing to do with the company itself, but they ultimately failed, and Upstart justifiably plummeted almost 12%. Just like Bed Bath, there's no price where I'd be willing to own Upstart. Then there's AMC. Oh, you think I'm going to come out negative, don't you? The one that's a movie theater chain run by Adam Aron? Now, wait a second. Here's the case where the company reported better than expected revenues and a whopping 59 million in attendance versus 22 million last year. Here's one where the fundamentals are getting better. AMC only lost 20 cents when the street was looking for 23 cents. To me, it's clear that AMC is off the critical list. No more of this. And Aaron celebrated when he came Squawk on the Street last week. I loved it. He also issued some preferred shares as an homage to his shareholder base, which is filled with shortbusters who call themselves apes. Jane Goodall. He even borrowed the term ape for the ticker of the preferred. There was some initial confusion about this move, a worry that it was dilutive, which is, of course, bad, something that Aaron cleared up on Squawk on the Street. However, the positive numbers did not appease the shorts, and they pressed initially. Then the longs came back and ran the stock up from 15 to 24 in a matter of days. When it got there, the short squeeze vanished, and the stock's coming right back down on big volume of 6.3%. All I can say is AMC is truly doing better, which makes it a terrible short. Rare case where the short busters have the fundamentals on their side. All right, how about this one? I used to love this one. Beyond Meat. Okay? Stock ran from 32 to 40 in a heartbeat recently, the latest leg in a 72% jaunt since mid-June. On what? On nothing except for the shorts. 37% short position this one. It's been a rocket ship of late, but I question its ultimate trajectory because the faux meat plays losing a gigantic amount of money. I mean, much more than I ever thought it was capable of losing. More importantly, they're not winning where it matters with the franchisees, major fast food chains like McDonald's. In fact, JP Morgan just put out a scathing piece pointing out that Beyond Meat failed its trial at McDonald's because the product didn't sell well enough. That can often doom something. We've seen the same thing at Yum Brands and Panda Express. Beyond Meat's fundamentals are beyond awful, and the whole run here was about this short squeeze. But on a day like today, that's not enough, and the stock plunged nearly 6%. Who else can be considered in the class? Wayfair, Big W, been holding up surprisingly well after miserable losses that only abated during the worst of the pandemic. Got to close all the other furniture stores for them to do well. The online furniture retailer says it can go back to that positive period. But I see no reason to believe them unless you think that we're headed for another COVID lockdown. I don't know, like in China or something. However, Wayfair's 26% short position means there's only so hard the stock can get hit before it finds the floor. I don't like it even after today's $12 decline. But if you try to bet against it, you'll probably get squeezed. If you want furniture exposure, may I suggest Apple Williams-Sonoma, which is genuinely profitable and also much cheaper. Finally, there's GameStop. Yeah, the original meme stock, GameStop. What am I going to say about this one? Actually, I've chosen not to emphasize it because it actually has a big cash position. Thanks to a big equity deals that it's been offering, it also has only a 23% short position. When you look at the core business of video game sales, GameStop probably deserves to be shorted. Even the best players in gaming are struggling right now, and GameStop is one of the worst. But the company has that big pile of cash. Gives them what I call optionality. Even though the stock's dramatically overvalued up here, it feels like a push because it has the financial flexibility to reinvent itself, hopefully as a companion and training tool to the Metaverse Quest product. Funny, the original meme stock is losing money hand over fist, and it hasn't been fixed at all, yet it doesn't have a colossal short position. Why? I think the shorts have been burned too many. Once burned, twice shy. GameStop's got a halo around it because the short busters are so relentless. Here's the bottom line. In a market that's presenting you with ample opportunities to lose money, I can't endorse buying these money-losing stocks in the hope of engineering a short squeeze. Sooner or later, you'll end up with a day like today where that tactic just blows up in your face. Carlos in New York. Carlos.
Hey, Cramer, thank you for taking my call. My 16-year-old son, Simeon, started working this summer as a lifeguard. He has been investing 80% of his pay in stocks. He wants to know, where should he invest his next pay? Kraft, Heinz, or Intel? Now, remember this. They both pay dividends. Obviously, you know this.
Right.
Now, okay, so he wants to get your advice. Kraft or Intel? My son wants you.
Oh, please give me a third one. Please give me something else. Please, give me, I don't know, how about, look, I love a 6-year-old doing that. We're giving him a J&J. We're not going to let them do Kraft or Intel. You know why? Because we like youth, and we stand for youth on Mad Money. That's our plan, Carlos, and we're not backing away from it. Let's go to Kenneth in New York. Kenneth!
Hey, Jim, how are you doing?
I'm doing well, Kenneth. How about you?
I'm doing okay. Hey, I just wanted to get your thoughts on Generac Holdings, ticker symbol GNRC.
I like that company very much. I am surprised it's down 30% given how bad our grid is. It's your hope in a bad grid universe. I say we buy Generac. Oh, how about Peter, my home state of New Jersey? Peter!
Hey, Big Jim. Listen, nice talking with you. Thanks for taking my call.
Same.
Thanks for your knowledge, sharing your knowledge and your positive attitude. It really means a lot.
Oh, you're very kind. Very kind.
Jackie and I have we have a 2-year time horizon, and we've got a couple stocks that we're not trading, just holding. They're Facebook and Google. But there's another one that we're thinking of adding to it if there's any life left in this puppy, Snap. What do you think? Just holding it for 2 years.
No life. We're going to have to worry about Snap from now. We don't want to do that. I like both of your other stocks better. And the one on Google's got in trouble with the Justice Department again. What the heck is that? It'd just be worth more if they break it up. So that's my game plan for you. Now, I can't endorse buying money-losing stocks in the hope of engineering a short squeeze. A lot of people feel I busted one this very morning with Bed Bath & Beyond. If it was my fault, I'll take it. Sooner or later, you end up with a day like today where that tactic just blows up in your face. Remember today. On Mad Money tonight, should investors use today's post-earnings dip in Take-Two Interactive as a nice entry point to play the video game maker stock? I'm digging into the action with the company CEO. Then the restaurant business has struggled with inflation on food, so I'm going straight to the expert, Danny Meyer, to learn more about the impact on food service in the U.S. and going out. And Planet Fitness fell mysteriously today after posting a top line slight miss for the second quarter. So what happened to cause the company to lose its hard-earned gains, and can they come back? I'm breaking down the report with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.